Welcome to the Commercial Property Podcast. My name is Susie Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.susiecarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. Welcome back to the Commercial Property Podcast, and today I'm going to be talking about numbers, but more specifically about the 7 numbers that every commercial property investor needs to look at when they're looking at deals. And hopefully I'm going to demystify that today and explain exactly what they mean and kind of how you can quickly calculate them. So let's get going. So the reason I want to kind of talk to you about this is because commercial property isn't complicated, but it is numerical, and there's certain key metrics that you need to understand. Now, if you've been listening to this podcast previously, if you've been investing in commercial property, you'll know that commercial property is really all about the tenant, the rent, the yield, and the lease. That's what we're really interested in. And so it won't come as any surprise that some of the numbers I'm going to talk to you about today revolve around all of those things. So the numbers will tell you whether a deal is a good deal. There's also more qualitative numbers there, like supply and demand. I'm not going to talk about those today because I've done other podcasts on them and I can do them in the future. But we're going to stick to the numbers today and make sure that you understand it. And just one thing to reiterate before we get going is that what we don't do in commercial, or you're going about things the wrong way, if you take the asking price and take 10% off it and say, gosh, I'm getting a great price, that's not how we work out commercial property deals. We work out what it's actually worth to us. And so by using these numbers that I'm about to tell you about, we can work out how good a deal is or how bad a deal is as well. So let's get going with the first one, which is yield. Now, I do find sometimes that commercial property yields can feel like this kind of esoteric number that nobody really understands. But basically what a yield is a reflection of risk. So we actually call the yield the all risks yield. And what that means is that we take all the bundle of risks associated with a commercial property, or rather a valuer does, and then we'll kind of basically reflect it in the property. So the starting point will be comparable evidence, ideally from the subject property, but we can take it from, neighbouring similar units. And then obviously the skill of a valuer and the skill of a commercial investor is to take that yield from other properties and to adjust it for the subject property. So for example, if you're taking comparable evidence and those properties are occupied, have tenants in and long leases, and your property is vacant, then your yield is going to be higher because it's more risky. And when a commercial yield is higher, that means the property value is lower. That's just, if you come from the resi world, you'll be a little bit kind of befuddled by that, but that's the way it works. So a higher yield means more risk. A lower yield means less risk, more prime type property. And we can judge how risky a property is from exactly the metrics that I've just said. It's kind of how good the rent is, how long that rent's going to be paid for, so the lease length, how good the tenant is, what the tenant covenant is, and we'll talk about that shortly. Basically, how long is that tenant going to be around in order to pay that rent? That's what we're really interested in. And also, who's going to be there if that tenant ever leaves to take a lease on the property. So there are kind of benchmarks we can look at. So, the big surveying agents, they will publish yield charts. People like Knight Frank will publish a yield chart where you can look at different types of assets and look at ballpark yields. That can be helpful. But you can also speak to commercial agents. You can look at comparable deals. You can look at, you can also look at things on the market and really get a flavour of it. And there's certain kind of ballparks for different types of property, but don't just take those ballparks. You must make sure that you're kind of applying the yield that's relevant for your particular property. So first of all, start with the portals, look at similar properties for sale, move on to getting comparable evidence from agents or from prop tech like CoStar or Adozo, and then adjust that for the specifics of your particular property. And it sounds complicated, but you will get your head around it relatively quickly. And just as a key insight, a high yield isn't always a good thing. Yes, you're going to be getting a good return on your money, but there's usually a reason for that because there is more risk. So, and the goal of commercial investing really is to get yield compression. So what we want to do in an ideal world is buy at a higher price, add the value to the property, and then get something called yield compression, which is basically we buy say at a 12% yield, we get yield compression to 11%, or we buy at 9% and we get yield compression to 8%, because a valuer will look at that property as less risky because we might have let a vacant property, we might have extended a lease. There might be all kinds of reasons why we've actually added value to that particular property. So that's the yield. So number one metric's the yield. Number two is the passing rent. So that's really important because a passing rent tells you the income today. Now, it's really important to note that that isn't necessarily the rental value of the property. That just means the rent that the tenant is paying today. And there's all kinds of reasons why that could be different from what the actual market rent is. It could be that the market has risen or the market's fallen. For example, we saw a lot of rents rebased during COVID in the retail sector. Now, unless you've had a rent review or a lease renewal, a lot of tenants will still be paying pre-COVID rents, which are actually a lot higher. And of course, the opposite can be true. If the markets have fallen, then potentially the rents or sectors have changed. Potentially the rents might be less. So your income today is important because you know what you're going to be getting, but it's not necessarily the rental value of the asset. And, really that's just the starting point. So number two is the passing rent, but number three is also really important, which is the ERV, or the estimated rental value. And what that is what that property would let for in the open market, what you should actually be achieving. And of course that can be higher than the passing rent or it can be lower. And what that will really assess for you is your opportunity to add value. Because if your passing rent is higher, then basically if a valuer is looking at that, they will say, well, you'll get the passing rent for 2 or 3 years, but then ERV will kick in, which is actually lower. So it'll affect the property value.
This episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
And but obviously if the opposite is true, where there's a gap between the passing rent and the ERV, i.e. there's potential for rental uplift, that's obviously where your profit is made. And how we calculate commercial values is rent divided by yield. So every time the rent goes up, the value goes up of the property. So, rent is super, super important part of our equation and something we're very interested in. And of course, if you buy a property where there is the most demand, high demand, lots of people waiting in the wings to lease it, then a valuer is going to be pretty sure that you're going to get maximum rent for that property, and therefore your value is going to be increased in value. So supply and demand is really important in terms of determining the rent. So number three is the ERV, or the estimated rental value. Number four is something you might have seen in brochures called the WALT, or the weighted average unexpired lease term. And what the WALT tells you is basically taking into account a multi-let property where there's lots of different tenants on different rents and leases expiring at different times, what the kind of weighted average of that is. And the way you calculate the WALT is the rent on each unit multiplied by the years remaining on that lease. So if the rent on one unit is £10,000 per annum and there's 5 years left, that would be £50,000. And then you do that for every tenant. So it's the rent multiplied by the years remaining on each lease divided by the total rent at the time of purchase. So divided by the total rent, and that will give you the weighted average unexpired lease term. So if you've got a long WALT, a long weighted average unexpired lease term, it's quite a mouthful, that one, isn't it? Then you're going to have some stability, because obviously there's longer leases. Valuers are going to look at that. They'll look at the tenant covenants, which I'll come on to in a minute, but they will look at that and they will see that there's some stability there. Short WALTs, short lease lengths across the property mean an opportunity or potentially a risk. Obviously, that's always two sides to one coin. Because an opportunity, because actually if there's great tenant demand, then you might be able to let the property for more. You might be able to do some asset management, like carving space up to get higher rents or whatever else it might be. You'll definitely see a valuation uplift if you can manage to kind of renew leases or get longer leases in place. But obviously it could be a risk because, if a tenant's going to go, then, what's the letting market like? Are you going to be able to achieve a similar type of rent? So all of that needs to be taken into account when you're assessing your property. So WALT is a really important thing, and you will see that on marketing brochures quite a lot. Number five is lease length and break clauses. So lease length is obviously really important. Why? Because it tells you how long a tenant is going to be in occupation for. Now, a break clause is also super important because what a valuer won't do is look at just for the sake of argument, a 10-year lease and if there's a break clause, an annual break clause, they won't value it as a 10-year lease. They'll value it as an annual lease because they will always assume that the tenant will break their lease because that's their job. They have to look at the downside. So a 10-year lease with a 3-year break is a 3-year lease, not a 10-year lease. So if you're looking at particulars and it says that there's a 10-year lease, then you get the lease and you actually see there's a break clause in there. Remember that you're not valuing the whole lease length. You're valuing up to the break clause if it's a tenant's break clause. But lease lengths are important because a tenant is tied in for that time period, and valuers will hit assets in value because they're more risky if they have shorter leases, because ultimately a valuer will always assume at the end of a lease a tenant will walk away. Now, your job as an investor is to basically convince them that that's not going to happen, but the best way of convincing them is by agreeing a lease renewal, signing a new lease with a tenant, and then you can prove that they're going to be there for the foreseeable future. So lease length and break clause, those two kind of numbers are really, really important. And given that commercial valuations are all based on rent, tenant and lease, obviously it's a massive factor, as well as lease terms. It's a massive factor in terms of determining the value of your asset. So really, really important one, number 5. Number 6 is covenant, tenant covenant, or the quality of the tenant. What we're really talking about here is whether that tenant is going to be around until the end of the lease and beyond. So, it's all very well signing a 20-year lease with a tenant, but if they're going to be in financial difficulty and go under within a year, then, you need to know that. So whenever you're letting to a property to a tenant, or if you take over a property with a tenant in place, you want to be making sure that you're doing covenant checks, and they can include looking at recent accounts, 3 years of accounts, getting a professional to check those over, doing credit checks through Dun & Bradstreet, Experian Credit Check, Credit Safe, any of those that you feel comfortable in using, but they will kind of look at the tenant in the round. You want to Google them. You want to be getting landlord references if they're SME type tenants, finding out where else they've got space, finding out if they've got any rent defaults elsewhere. just getting a real picture of it. And if you can't get yourself comfortable on that, then what you want to do is be bringing in guarantees. So you want a personal guarantee or a guarantor or rent deposits or all of the above, just anything that can make you feel comfortable that actually you have you've got some security if a tenant is a bad covenant. So a strong lease is only as good as the tenant who's basically behind it. So it's great having the best lease terms in the world, but if the tenant's not going to be here this time next year, then obviously that is a problem. So in this AI world as well, this Amazon, this online world, this AI world, we also want to be sense checking our tenants against, sectors, types of tenant, types of business, to make sure that we think they're going to be future proofed. Things like service-based industries, something where, things happen physically, are quite future proofed. So, it's definitely worth thinking about that kind of stuff as well. So number 6 is tenant covenant or covenant strength. And number 7 is price per square foot. So what I'm not talking about here is price per square foot on a rental, but that's very important because you can use that to look at comparables. I'm talking about price per square foot or per square meter. I mean, I'm still talking old money, but it's basically a capital value benchmark. So what you want to do is you want to look at comparables and what they've sold at on a rate per square foot, because that will give you a really good comparator for your property. And it tells you whether you're buying well or buying poorly compared to what's happening on the market. And certain types of property in different locations, they will have a general tone of what they're buying and selling for. And obviously, if you're way outside that, unless there's a good reason for that, that potentially is an issue. So it's basically where you sanity check the deal against reality. So look at that price per square foot. Agents won't necessarily give you that in marketing particulars. That's up to you to look at. And if you've got prop tech like CoStar, they will give you a lot of the comparables in a price per square foot basis. So it's where you sanity check that deal against reality. So 7 metrics there, 7 numbers that are, really important. Obviously, I could talk to you about IRRs, I could talk to you about MPVs, I could talk to you about all kinds of things, but they are the basic numbers that you need to be looking at in order to start kind of understanding and assessing a deal. And the power of niching, the power of going an inch wide and a mile deep in your investing niche is that you start to understand your investing location in relation to these numbers. Obviously, the WALTs will be different, and but the ERVs you will understand for different types of property. You will understand the price, the capital value per square foot. You will understand the yields. You'll start to get a really good flavour of what's happening in your niche, so that you don't, every time you're doing a deal, you don't have to be phoning up agents and having those kind of conversations, which slows down deal analysis. You especially if you had valuation reports done, you can refer to those very quickly, and you just start to really understand your investing niche really, really well. But what's really important to say about all these numbers is that no single one of those numbers is the most important, because they all matter together. And it's the combination that matters. So, a high yield, a weak tenant, a short lease is risk. That is a risky asset. Now, you might be comfortable for that because you might be able to do some asset management to make that less risky. You might be able to put a longer lease in place, a better tenant, which will subsequently bring the yield down. But, you need to know the starting point. On the flip side, a lower yield, a stronger tenant, a longer lease is security. That's going to be a more prime asset because it's more secure. A low rent versus a high ERV is an opportunity. So some of the relative and the comparators between some of these metrics is really, really important. So don't focus just on kind of yield alone. Don't focus on rent alone. Don't focus don't ignore lease terms, really important, because lenders and valuers are very, very concerned with lease terms. Don't assume the passing rent is the market rent, the ERV, because they can be very different. Make sure you absolutely check that covenant strength properly and make sure you understand exactly who your tenant is. And don't overpay because something looks like a great deal, but you haven't analysed some of these numbers well. So, when you're next looking to deal, don't say, do I like this property? Does it feel good? But what are these numbers telling me? And, the ultimate way to check these numbers is to get a valuation report done. either via your lender if you're getting finance, or actually from a lender's valuer, for valuers on the VAS panel who are acting for lenders, so that you understand exactly whether you're just making assumptions that are correct, or whether actually a lender would look at it in the light that you're looking at it. So commercial is very much a business mindset, so that's why we look at these numbers. And so next time you look at a deal, make sure you very much do these checks and balances to check whether it's a deal you should be doing. So hopefully that's useful, and I look forward to seeing you next time on the Commercial Property Podcast.